make a decision, and then if you f it up, then we'll fix it. But don't overanalyze it. Just make the decision.
Maybe if the Fed is done hiking, then now for the next year, the trade might be to own small cap.
I want this trade to pay for Christmas. Santa's coming to town. Welcome, traders and enthusiasts, to another captivating episode of What's the Trade. On today's episode, we have the privilege of delving into the world of trading and market insights with an exceptional guest, an unbelievable trader, and none other than Jason Ruchel. Welcome, Jason. Welcome to the podcast.
Thank you, Tony. I appreciate you inviting me on your show today just to talk trading. And I know I've been following you for a few years now and kind of understand your trading style is all about options, and that's definitely what I prefer using and talking about all day long. So happy to be here.
Thank you, Jason. Can you tell us a little bit about your how you got into trading and what made you get into this crazy thing that we love?
Yeah, good question. I think I remember back in 2006, I was like in college, and that was kind of the end of that last big bull market before the financial crisis happened, and I just started reading about options and dabbling in how you can make double your money or whatever, like everybody knows, right? So I remember buying a Google option because that was back after they just went public, I think, in the early 2000s. But I think I bought an option on Google, and it was into earnings, of course. So that's the last thing you want to do.
You bought it or you sold it?
Oh, I bought it. I bought it.
You bought it. Wow.
And you know what? The next day I woke up and I made money because Google went up huge, more than expected, right?
Wow.
But back then I didn't know anything about volatility or expected moves and really options markets in general. So I made money on that trade, but I think I lost like 5 in a row after that. So I knew I had to learn a little bit more about this game because the potential was there. And then, of course, just going through college, I was majoring in finance. So I started realizing that they don't really know how to teach this kind of stuff in college. It's more so academic and by the book, and how you should always focus on index funds. But, the options market was growing pretty fast in 2006, 2007, 2008. And then with the financial crisis, volatility exploded. And that's when I kind of learned more about trading spreads and how to use maybe some option selling strategies to give yourself a higher probability.
Right. And tell me, one of the hardest things for people when they start trading is growing their pile, because, the first rule to make money is you need a little bit of money, right? So
Yeah.
what did you do at the beginning to start making, a little bit of trading capital?
Well, I mean, I had a summer job that I worked for my uncle back in college, and it was a pretty good opportunity to save some money. Um, you know, when I didn't have much, so I kind of funded my own trading account through that, and just really starting out with like $5,000 in my trading account. I remember in college, and to a 20-year-old, that's a lot of money. So
It
I
is.
was like, I remember the first time I lost like $1,000. From the peak of my account, I was like, man, this sucks. I can't do this. But that's honestly, that's kind of how you started learning and understanding risk more. Because I think trading, no matter how much your account size is, like you realize that you have to take risk, and learning how to take risk in the markets helps you take risk in life or whatever you want to do in life. You're a business
Definitely.
guy, and it helps you understand risk reward, right? So you get
Right.
more comfortable taking that risk reward into other aspects of your life. So
Yeah.
long
Definitely.
story short, I just tried to stack up savings during summer jobs and add to my trading account, and eventually get it a little higher towards the end of college. And obviously, the more you could save when you don't have expenses, that always helps.
Of course.
You
Yeah.
know, even just slowly learning the options trading game when I had less money to lose was actually a benefit. Because if I came in like some people nowadays, and you start with 50,000 or more or 100,000, and you don't even understand what you're doing, you could lose half of that pretty quick, and that's a big chunk of money. But
You know,
back when I
it's funny you say that because I come from an entrepreneurial family, and I started my business career as an entrepreneur out of college. I didn't get out of trading, so I founded one of the first internet companies in Latin America before the World Wide Web, and I sold it for several $1 million. I mean, when $1 million was a lot, so we got and then I thought I was a big shot because I've always been good in school. I always got straight A's, and I was great in math. I said trading for me. I mean, what are you kidding? I just created a company, sold it, blah blah blah. So the first 6 months when I started trading, I lost $400,000. So exactly what you said. And when $400,000 could buy you a house in California, that's how much money it was. So I got into trading with even my dad told me, "You're an idiot. I mean, you know how much money you lost? You're So I got into it. I was lucky that I made a great company, etc. But I didn't know what I was doing when I started.
Sure. And like I think everybody kind of doesn't understand fully what they're doing or what their game plan is unless they're exceptional in following a mentor from the start and
Right.
really kind of learning everything first before diving in. But I think with options trading in general, whether it's shorter term or more longer term stuff, you have to jump in and lose a little bit to understand what is going on. So as long as you could kind of start with a small, even if, like I tell people, even if you have like $50,000 to put into a trading account or an investing account,
You're right.
maybe put in 20 first, and then test the waters a little bit and dip your feet in with some strategies and see how like the first 25 to 50 trades go. Don't worry about one trade or two trades. People get too caught up in single trade outcomes, but you got to think of a sample size of 25 to 30 trades in one
Right.
month or whatever your time frame is, and then go from there, and then try to get that probability of success higher. Maybe start, just try to shoot for 60% win rate, and then go
Right.
from there.
You
But
know,
you're going to have to build confidence to be more consistent, of course. So
100%. I always tell people, if you haven't blown up one account, you you still haven't made it. So
yeah, I mean, some people say that's not necessary, but I kind of feel like that helped me because I started out with like 5,000 probably when I was 20, and I went up a little bit. I think I like went up 50% at least in a few months, and then came all the way back down to the starting point, and then took a little bit too much risk. And I remember blowing up at least that one account and starting over after 5,000 was gone. And back then, when I was 20, 21, that was a lot of money because then I had to
right.
work all summer to make it back and have a new stake, so to speak. But honestly, at that point, I wasn't really like worried about 5,000. I knew if I could figure this out in 5 to 10 years, I could, make 100,000 or
Right.
more, right? Because
Right.
that's, it's, you think of it as tuition, right? You go to college and pay all this crazy money to
Of
learn
course.
about, a lot of junk sometimes,
Right.
but you don't learn how to be an entrepreneur by going into a classroom, right? You don't learn how to be a trader by going into a classroom. You have to put money at risk, whether that's 5,000, 10,000, or 20,000. You have to think of it as tuition. If you start out in the first year or two and lose that tuition, then it's kind of like a life skill. You learned something based on your comfort level, and maybe you took too much risk. Then
Right.
okay, now you figured out maybe my risk tolerance isn't as high as some people. Maybe I should stick to higher odds
Definitely.
situations, or
Definitely.
just kind
Mhm.
of lower my position size.
Of
All
course.
that stuff you learn from mistakes. So
My friend Tom Salzman says that trading teaches you a lot of life skills, and one of them is making quick decisions.
yes,
Quick decision making, not only for trading, for life. And I lived in Japan after I got my MBA, and one of the things I learned in Japan is make a decision, and then if you f it up, then we'll fix it. But don't overanalyze it. Just make the decision. And I think that's why Japanese people are so successful. They take many risks with business, with ideas, and of course, sooner or later, smart people making a lot of decisions, some of them will hit, and they'll become successful. So great. Let's talk about your trading, which is, I admire the way you trade. I admire people that not only trade but can write about trading. You're very eloquent, you're very smart. So I'd like to start and asking you, how do you create your assumptions for your trades? How do you decide if you're going to go bullish, bearish, or neutral on an underlying when you trade?
Yeah, I mean, I'm just first off, I kind of definitely focus more on the um, swing trading type of time frame, like a couple weeks to even up to a month or so, maybe even longer if something is going my way. But I really kind of take like the whole idea when I started that Three Peaks website was kind of thinking about trading from three angles, right? Like talking about trend and breadth of the markets and understanding how strong internally the markets are moving, whether it's up or down, and then
Right.
taking into account sentiment readings, right? How the market is positioned. Is everybody short and the market is oversold? Well, then just like the past 3 weeks, you're going to have probably a crazy short squeeze at some point, and you want to be guarding against that and not be in that camp, right? You want to kind of go against the grain and be contrarian when the market is very extended to one side. Um,
Yeah, it's very
so
hard to be. I'm a contrarian trading, and this last ramp up, 8% in whatever 6, 7, 8 days. I mean, it really puts you in the house of pain.
Yeah, and to be fair, I was very bullish going into November because it's one of the most seasonally bullish months based on a lot of different factors, especially going into a pre-election year. Just looking at my stats, I like to track seasonality going back 100 years and understanding the year before an election definitely closes very strong, like 90% of years, November, December, from what I've seen in the numbers. So I was not trying to be too short going into the last 2 months of the year. And really, just honestly, like the moves, no matter how long you watch this stuff, like even if you're bullish and you think you get a big move, like it always goes farther than you ever imagined, right? And longer than most people just um, they're all like even myself this past week I didn't think we'd probably race above 4500 on the S&P before
Right.
Thanksgiving. I was thinking that might happen in December, but the velocity of these moves and it shows how underpriced I definitely like to do a little option premium selling, but also I've gotten a knack for understanding when to buy options too, and understand when implied volatility, or at least realized volatility, is a little cheap compared to the implied move.
Right.
And I think the past 2 weeks showed that the front week options are pretty dangerous to sell, especially naked. So this month has been kind of one of those rare examples where implied volatility was kind of understating the real magnitude of the move
Right.
potentially, right? So we saw, I think, if you go back to November 1st, like the expected move for going into November expiration was something like 150 points, and we've
Yep.
moved up
Yep.
300, I think. So
It's
it's
300 in a second. Yeah.
yeah, and that's why even I know like Tasty Trade and a lot of like premium selling is great and it's high probability, but you really want to focus on 45 days to 60 days away. And I think
Definitely.
that's one of the biggest things I focus on if I'm selling options, whether naked or spreads. I go a month or two or even 3 months out and just you get rid of that gamma risk of the velocity of the move can
Yep.
really bite you if you're wrong in
You
that
know,
front week or front month.
I have a few rules that I teach my kids. For example, don't sell naked calls. And
Yeah. That's the thing. Like a lot of people like to sell strangles. That's fine. If you're going to do that, make sure you know that the risk is to the upside usually,
oh
because puts are always overpriced, but calls I feel are very underpriced. If you get a move like this month, you can get hurt on the upside way more often than the downside.
yeah,
And
because
you can hedge, of course, but the risk is, I think, naked calls. I try to avoid selling naked calls unless it's a special circumstance. I prefer to like even do a two puts one call type of thing. If you're going to
definitely,
sell naked,
definitely.
maybe skew it.
Skew it. You know what I like to do? I like to do upside ratios where I buy like at the money call, a little out of the money call, and they'll sell two further up calls, and that's and for a credit, and that has it takes my desire to sell short calls because I'm still selling one extra short call. But in my mind, I'm still gonna profit if we go up a little bit. So that's how I, like a trader addict that I am. That's how the addict gets his fix with with the call ratios. So it's cool, yeah. And there's many ways to get assumptions. Uh, Technical analysis, fundamental analysis, your gut feeling, and implied volatility rank. Who knows? So I'm curious, Jason, what do you use? What's your go-to to create your assumptions?
Yeah, so it definitely starts with what I focus on, full time. I'm an analyst at optionshawk.com, and we focus on, unusual option flows. And a lot of people that hear that might say like, oh, that doesn't work. But if you actually understand like the flows and the trend of flows going not just one day of a weird unusual trade, but
Right,
looking at days and weeks upon unusual action, like a lot of times the past month or so, we've seen accumulation of upside bets in the bond market, like
right,
TLT or even IWM, small caps, right? Both
definitely.
of those have been just beaten down the last 3 months.
Right,
Uh, but
right,
when you start to see multi-million dollar option trades in big blocks come in aggressively, and not just 1 day or 2 days, but 1 to 2 weeks consecutively, right? Building and accumulating lots of positions for the upside in the next 3 months or so, even longer term. Leaps are always a bigger sign, or in the money put sales are a big signal that the floor is probably in, and you want to be selling puts as well. When I see
right.
institutions do that day after day after day, they're accumulating a multi-month type of bet that you want to follow, or at least it gives you that idea generation. And that's how
Yep,
I use option flows for the members at the website. Is like, if you're seeing repeat action like this, there's a high probability that you want to try to structure a trade that takes advantage of that the next several months or even shorter term. So it starts with that kind of idea generation, seeing what the big institutions are positioning for going forward,
yep,
and
yep.
then looking at the chart, maybe using a little basic technical analysis. I like looking at volume profiles. I
Okay.
try to avoid multiple indicators and stuff to make you overanalyze things, but like you said earlier, like if you're overanalyzing things and not quick to make a decision, you're going to struggle long term because, like you were saying, the power when it comes to making a quick decision is like you're not saying you're going to be right each time, but you understand how to move on and go to the next trade. Like if this one
Right,
doesn't work out, you got to be sure. Like a coach in football, right? There's 2 minutes left in the game. They're not looking at 30 different plays. They already know one or two plays they're probably going to go with in that situation, and they're going to probably be quick on the trigger to decide that because they need to be looking ahead and really, I think seeing the option flows and then the trend on the chart and understanding where the market is positioned. Those are three things I really lean on and understand. Like if everybody's positioned to the short side, but then I'm seeing
yeah.
potential for a big snapback reversal, then that's the signal I like as a contrarian trader too.
Of course, of course.
That
That's
doesn't mean
good.
I don't follow trends, but a lot of times, especially I think the last year or two, it's not really been a trending market. So
No, 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 no.
it's a mean reversion market, and you're kind of better off fading the public when it comes to that.
I think there's two types of traders. One that's more opportunistic trader. I consider myself like an opportunistic trader or a campaign trader. And what do I mean by a campaign trader? It's a trader that trades no matter what the market is doing. They have their trading strategy and they execute their trades. And I want to become a better campaign trader because I think campaign traders are very successful, and but I'm struggling because I trade very opportunistically, and I wanted to ask you how do you get away from that?
So when you say you're saying campaign trading, so um, what exactly would be an
Well,
example of that
let me
reason?
tell you, for example, I have some very successful friends, unbelievably successful friends that they do two or three strategies only. and
Mm.
no matter what the market is doing. So every Wednesday, uh, you see, I only do one campaign trading. We'll sell every Wednesday SPI straddle, SPY
Okay.
straddle. So a campaign trader is someone who allocates a portion of their capital, maybe 10-15% to a strategy, and then they allocate that amount of capital into weekly timeframes, and then no matter what the market is doing, they place that trade every week, every month, etc., to generate income, and
Okay.
that's
Like a
something that,
passive.
yeah, I haven't mastered that. I want to become a better campaign trader, and but I always fall back to being an opportunistic trader, finding extremes, uh, upside or downside, and then take my trades. So I want to get your thoughts on that. Yeah.
Yeah, that's very interesting because I kind of fall in that same boat with you. Being more opportunistic based on doing this full time and understanding. I look at a lot of data and a lot of analysis throughout the week and the months, and kind of I think if you can be opportunistic to see like those one or two bigger trade setups during the month, then you don't really need to place like 150 trades a week or 150, like a lot of day trading. Like that's just not my style anymore. And unless the VIX is like over 25 to
Right.
30, they're just I prefer like that 1 to 3 week type of trading time
Right.
frame. But yeah, like I kind of I would like to be more of the campaign passive type of trader when it comes to options, but
Yep.
more so from a higher probability standpoint. So I
Right.
think if if the markets allow, it's always based on what the markets are doing and how I feel like I have a pretty good knack for understanding what that next 5% move might be in a
Right.
specific underlying or a market in general, and understanding which sectors might lead that move. So
Hmm.
it's more of a challenge to me. I like it's almost like figuring out a puzzle, right, or a
Right.
treasure hunt in the market. I like that challenge and that fun, stimulative type of thing that you can gain, a lot of short term profits in if you are right on your opportunistic viewpoint. But being more passive and understanding like maybe selling a put every 2 weeks on the S&P 500, like 10% out of the money or whatever, like whatever support level you think you'd be willing to own something, and
Right.
having a cash secured put portfolio is something I am trying to get more into, as long as the market is allowing that and kind
Right.
of trending in an upward direction. I think we're in a bull market. I know not a lot of people care if we are or not, but uh, you know I do like selling puts on strong names
Right.
when we come back down to
Right.
support levels, or specifically I look at expected moves each week, whether it's for the indexes or key stocks. And when a name or a S&P 500 index comes back to the expected move
Hmm.
on the downside that week, that's a good time to sell some
Yeah.
put premium or whatever your style is. But
Yeah,
yeah,
definitely. I think what I love about trading is I want to use the casino analogy. Casinos have to take everybody's trade, not only my trade. And the cool thing about trading is that we don't have to place trades every day or every second. The casino has no choice. Our counterparties like Citadel, Susquehanna, Goldman Sachs, they have to take all our trades. And what I like about trading is being opportunistic. And I'm going to give you an example of a campaign trade that my kids are doing. If you don't mind me sharing, because my kids, they're young adults, and they don't have a lot of money, but they have this campaign trading that I showed them. So we always go 1 year out. For example, right now, unfortunately, they don't have money for SPX, and
sure.
SPY only has quarterlies.
Oh, I
So
see.
so, for example, we can go
Yes,
September, and when you trade, the capital required for a trade is normally 20% the strike price. So, for an example, for a 400 strike put would be $8,000. So we're always looking like for a $10 credit, because the $10 credit or the expected move will give you about a 1% return, 1% return a day. I mean, 1% return a month. So I think that. That's an interesting strategy that they try to do all the time. And a naked spy put maybe it's out $8,000, and if you collect $1,000 on 8,000, let me grab my trusty calculator. That's 12.5%, and then the stock market can go down. Right now, 40 points would be. Right now, volatility is pretty low. It's not. I don't like it right now, and
But you
mhm,
But you see, the farther out you go, the higher the implied volatility is.
right,
So you're
right.
doing the right thing there, because even going out 1 year on a leap
Yep,
option is going to give you a higher probability of staying in the trade until you make money, right? Because a
right.
lot of people might sell a 30-day put,
Yep,
and then you see like one down week, and you're like, oh shoot, I
oh
got to get
shit.
out of this thing.
Yeah,
Yeah. So,
but
but going out
hmm,
even 9 months or 12 months,
yep,
you don't really get hurt until a very big outlier happens. But
yep,
of
hmm,
course, you could always use risk management too. Like I would say in that case, I've done the same type of trade. Actually, I was selling puts 1 year out, like last month on the SPY, and
wow,
I already made 50% and got out of it. But if I was wrong and it got to 2x my credit, I would just get out. That would be my
right,
risk right there.
right. It's very
Unless I want to own it, right? I would not mind holding it, and if I have the capital to be assigned, that's fine too, because
yep,
then
yep.
you could just sell covered calls and wheel out of it and think of it as a longer term investment.
It's funny to say that my one of the puts that my kids had was the 345 short put when we were going down just 3 weeks ago, and they already closed it last Friday for a 55% gain. So this thing recovers fast, but it's a way to create some income. If you don't have money to buy an apartment and rent it out or something, it's the market can go down. Normally it's 15% down, so the market can go down 15% and you're still collecting your 1%. So that's an idea of a campaign trade that I think all of our your followers and our viewers can get
Yeah.
into.
And
And
another thing, you showed the SPY,
yep.
uh, but you could do the same thing in the ES futures or even the MES micro futures, and I think
Right.
it's a lot less buying power required. I don't know exactly off the top of my head, but if you go to the ES futures, they're
Sure.
just as liquid as the SPY, and you get to use span margining, right? So
Right.
I believe the buying power requirement is probably half of the SPY.
Oh,
I think
sure.
the commission might be a few bucks more, but that doesn't matter because futures options are a
Yeah,
little.
the margin is actually
So
it's half. So you're
yeah,
right.
and
You're right.
is that that's probably not a margin account, right? That's is that an IRA?
This is an IRA account because I have to switch it over to a the margins here are crazy, and let me switch it out to
But those ES futures are pretty fun to play with. I've been using them more and more the last several months, so it might become more of a strategy going forward.
definitely. And let me ask you, Jason, what are your most favorite strategies?
Okay. I would say it definitely depends on the volatility in the markets, right? And understanding how the markets are moving. But I really like selling put spreads or short puts. If you're comfortable with that, that's probably one of the best trades you could make consistently, as long as you kind of have a risk management plan and understand it. But also, I really enjoy butterfly spreads.
Oh,
When I'm trading more short term, especially in the SPX, because some of these 0-day options or even 1 week options provide a lot of good opportunity to buy like a 25 point wide butterfly, either at the money or slightly out of the money, and you're still going to kind of generate that positive theta and somewhat of a directional tilt. And it's not going to go against you too quickly. So that's the nice part about butterflies.
for,
Um,
for your naked puts, how far out do you go?
well, I mean, you're talking about expiration
Yeah,
or delta?
expiration and delta both.
I mean, I definitely, if I'm going to sell a naked put on something, it's probably going to be closer to like that 60 to 90 days now. I noticed I really prefer going out at least 2 months, sometimes even 3 months. And, it really depends on kind of multiple factors when it comes to picking the strike. I like to look at option flows and see is there a lot of recent put selling.
Yeah.
in the option flows telling me what strike to lean on because institutions are willing to own it at this level, then I'm more comfortable to own it at that level too, right? But I would just default to probably like a 25 delta and then wiggle around from there.
For
Sometimes as
example,
low as
I'm
sometimes as
opening,
low as 10 or 12, even if I feel like the skew is pretty high, and you could get a
right?
lot more option premium further out. But
Uh-huh. Right. Wow. So here I'm opening up January, which is 60 days out. And here I can see the volume we see here on the 440 strike. There's a lot of action. Is that something that might pique your interest, you think?
well, I mean, those round number strikes are always going to have fairly high, gamma or open interest.
Right, right,
Uh, I guess that's a volume right there. So maybe the open interest is probably even higher. But so it really kind of depends on where I see a floor in a specific name, and it kind of goes back to like looking at volume profile and understanding like where the highest volume traded on the year has been. Like point of controls are pretty important, and just
right.
understanding value areas when it comes to the charts. But um, yeah, I mean, really kind of understanding when to sell too. Like when implied volatility, nudges higher like it did in September, October, that's going to be your best time of the quarter probably to sell naked puts or come up with some kind of strategy to take advantage of that higher implied volatility. You can see now the IV rank is closer to 15, I think, on the SPY. So
Right.
it's not exactly juicy, so to speak, right now. But you could still kind of take advantage of that in a bull market because volatility tends to stay low for a long time once it
Right.
gets low, and
Right.
you know that already. But if you look at your chain right there, you're going to see the option chain. The implied volatility is going to be much higher further out. So
Oh,
if
definitely.
you want to sell options right now, that's fine. But I would go out 3 months instead of 1 month. But like a month ago, it probably would have been better to sell closer expiration premium because that was jacked up, right?
Yeah.
But now you're seeing like if you go out to January, it's like 15% implied volatility,
Right.
uh, but November is like 11 or whatever. So
Yeah. It's terrible. Yeah.
so obviously this is just one example in a big index, but
Sure.
you see that the wiggles are going to let you stay in the trade longer, and you're going to collect like the same amount of premium you collect for a December option right now, 27 days away. Um, you could take a lot less risk selling in February, even, which is 90 days out.
Right.
But instead of waiting for 50% win on that February options, maybe you could take 30% and take a lot less gamma risk in the process.
Right. Right. Look at the open interest on the round numbers, the 445, the 440. It's funny how that is, right? Human beings, 430. I mean,
Yeah, it's definitely based on probably a lot of different factors, but the institutions and the funds, they like to lean on those big round number levels for whatever reason, and it probably goes back to how much they are willing to hedge or whatnot too. But
right.
yeah, I think going into the end of the year, I'd be very surprised if the market pulled back sharply in the last 6 weeks, just because everybody is so under allocated and
Right.
underexposed. And it doesn't mean we're going to fly to new highs. I think in the next couple months, but it wouldn't be shocking if we challenged the 52-week high from last August, I guess it was. But
Right.
uh, it's definitely one of these markets where sentiment changes fast, and you kind of don't want to be on the other side of the boat when everybody's leaning to that side because it's going to probably switch pretty fast
Of
when a
course.
spark fuels it. And of course, like this November has been fueled by interest rates sliding lower faster than people think. So if that is truly a peak going forward into 2024, you're going
Right.
to see a lot of like lately I've been talking about small caps maybe outperforming NASDAQ. So that might be a trade finally going forward into Q1 of 2024.
My friend Tom has his worst trade of the year is being
Yeah,
short the
I know.
Nasdaq long the Russell.
I know
Uh,
Tom is always early, but
yeah,
I
like a
think the
year
next
early, like a year early. Yeah.
yeah, I think the next 3 to 6 months that might be the trade if you're looking for like
Right.
one higher odds thing. Is like
Right.
if interest rates keep sliding lower the next quarter or two, and the Fed starts hinting that they're going to cut rates going into summer of an election year, And I would not be surprised if you see that by the springtime, even to see a potential rate cut by like April, May, June. Then you're going to see small caps outperform these kind of overbloated mega cap stocks. And it doesn't mean that Nasdaq is going to tank, but I'd be much more willing to buy a Russell and sell the Nasdaq on a pairs trade going into next year now with that yield situation.
One of the cool things about Tasty is, sorry for my commercial here, but you can do pair trades very easily. You can choose your, I don't know if you can see the screen. You can be long and short, and then you can decide, hey, I want to be long, 100, IWMs against 50 QQQs, and then you can see how the chart looks, and it's pretty cool to be able to trade the basis instead of trading an underlying. It's very cool that you can easily place trades like a professional hedge fund. But I'm very curious about your butterfly. And will you be willing to like give us an example of your bread and butter butterfly that you like to do?
Yeah, I mean, I don't know if it's like it's not necessarily a bread and butter, but it just depends on the situation.
Okay.
Sometimes I use them for hedging, even like right now. For example, I have one small butterfly on for next week, expiring November 24th. So one
Okay.
week away only.
Let me
Um,
put it on. Do you know what you have on so I can put it here?
yeah, it's actually an SPX too.
Oh,
So
oh. You
I
know,
like
you know
I
me.
like
I'm Mr. SPX,
yeah
but
I
then people get mad at me because I only show SPX, and I'm Mr. S. Yeah,
I
I
actually prefer SPX if I'm going
yeah,
to do
yeah,
something shorter term.
yeah. Me too. Me too.
Especially since it's cash settled. So if
Definitely.
you know if I am not around, I could let it expire or whatever. But
Mhm.
so for now, where did we close? 45.14 on Friday. So I think the expected move is always what I look for first. So you could just kind of judge that about 30. Is that? Oh, that's for the 21st. It looks like Monday.
Do you do
Uh,
it on the put side or the call side?
well, right now, I'm kind of looking for a little bit of a pullback going into next week. So I have a put butterfly that's about 25 points wide, and I centered it, I think, at 44 25. Now,
Okay.
it's definitely down a little bit right now. If I were putting it in right now, I'd probably go for 44.50 because the expected move next week, I have it for the November 24th also. So that's
Right.
6 days till expiration. But you could just kind of look at the expected move or kind of shoot for like that
Yeah.
20 delta and center the butterfly around that 20 delta if you want to be directional.
You see
That's
here. Do you see the cool thing about Tasty? It gives you the expected move, which is right at the. You see the gray area right at the one standard deviation, and let me look at the. There you go.
Yeah. Now, like, of course, butterflies, they don't have like the highest probability of success, but you're not going to lose quickly on this. It's going to take a little while for it to be a loser, so you have time to wait. That's the nice part. And really, like this one specifically, I still have some longs in my portfolio that I'm leaning
Right.
in towards year end. So I kind of like to use these shorter term butterflies to hedge for like a week or two if I see a pullback.
Right.
And like this one, it looks like you have about 25 points wide, so you're paying less than $5 there. I mean, you could easily make 50% on this if we have a 1 day dip next week.
Oh yeah, definitely. And
So that's
I love butterflies. I love broken wing butterflies, and
broken wings.
I love this trade because even here you can see my mouse. We're hovering here at the 45.15.
Uh-huh.
Even if the market just it doesn't
Yeah,
even go into our tent. I call this the tent, and
yeah,
some people call it the trap. Even if it just starts approaching the 45.05 put, this put is going to explode in value, and
yeah.
it's going to lift the tent higher, and you can take a 100% profit. You could
Oh
this
yeah.
trade $9 easily, right?
Oh
So
yeah. And really, like you could kind of like let theta work for you once you get closer to that tent or that trap, right?
right,
You don't
right.
have to just jump out of it right away, but you could, let's say it just slowly grinds lower. Well, then the implied volatility might kind of help you a little bit. The positive theta might help you a little bit. So
Yep, yep.
you could kind of let it marinate for a day or two too before you get out, and you
Definitely,
might actually
definitely.
come out with a double. So a lot of times, if I enter a butterfly, I like to shoot for a 100% win because of
Yep,
that
yep.
that odds is there. So, Yeah, we'll see what happens next week. But a lot of times I like to use those for like weekly bets, like 7 DTE or so.
Yeah,
Uh,
yeah.
but on if we have like a FOMC day, sometimes I like to do the 0 day because those can really move fast on a
My
Fed day.
God, I've
If
had
you're
some unbelievable days of zero DTE, and I've had some,
Yeah.
you know,
You want to pick and choose your battles with those. Not every day because they're kind of addictive. A lot of people get
right.
way into that 0 DT and trade nothing else, but you want to just make it a complement to everything else, I think.
The problem with zero DT, in my point of view, for my personality, is that I'm stubborn and and I'm not disciplined. So you have to get out at 2x, like you said. And normally, if I'm 2x, I'm saying, no, 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 I'm gonna wait a little bit. Let's see this thing come back. It's gonna go, and then it goes 2x to 5x to 9x, and then I'm in the in the shit pit, and I'm in the house of pain, and then it's so hard to recover. So zero DTE is great for disciplined people, and
Yeah, especially if
that-
you're selling. You're talking about like a credit spread there,
right,
probably.
like
Yeah,
credit spreads, yeah,
yeah. I've done that with 0 DTE, and you're usually going to win 90% of those short credit spreads on a
right,
0 DTE. But you really got to make sure you're taking a loss when you're wrong because the 0 day gamma risk is huge, and
it's humongous, it's
especially on a more
humongous.
volatile day, you could sell a credit spread for $1 and it could be $10 if you're wrong.
Oh my God. Normally I like to sell, for example, I'll give you an example for, I mean, the market's closed right now, but let's say for November 20th, um, I would like to look for the put that's $1, let's say this one, and then go, I would say 30 wide. So, and then try to collect, I normally try to collect 50 cents on each side. But if you do it 50 times, like I'm like the maniac that I am, you know, you're risking 50 times to make, you risk $3,000 to make $30, which, when it goes against you, it's painful.
Yeah, and that just kind of goes back to managing the risk. Like the usually when it comes to options, I'm never going to risk more than 2% of my account on any idea, no
Right.
matter how confident I am. 2%, that's my risk on most option trades, and that's whether it's selling or buying premium. So if I'm selling a put, for $10 credit and it
Yep.
goes to you
Yep.
know 2x that, then I'm just going to get out, assuming I don't want to take assignment and own the shares. But if you're talking about a shorter term 0 DTE trade like that, yeah, you really
Right.
want to make sure you're keeping your risk in check and not risking more than even 1% sometimes on those shorter term trades. But yeah, if you're going to sell premium, definitely the credit spread is going to be the way to go to eliminate those outlier moves in the
Yep.
0 DTE. But that's why I do like using the butterflies because you get positive theta on those if you are closer to the money too.
Right.
So it's definitely you're paying a debit to get into a butterfly, but
Yeah.
you know right away you can be in positive theta if it goes your direction. So
Yep.
it's similar to selling premium when you buy a butterfly, but obviously it's a little different risk structure. So
Now, let me ask you, since you have a lot of clients in your options hawk and your three peaks when you started three peaks trading. Now what your options hawk, you tend to talk to a lot of traders, right? And I want to ask you, what are the most common mistakes that you see people making all the time?
um, so I guess like I would say maybe depends on your experience level too, but um, really kind of understanding the time of the month is pretty important, and not getting too over leveraged or overexposed, especially during like options expiration week. A lot of people
Right.
might
Right.
overtrade or have way too many positions on, and options expiration week is often kind of a trendless type of week unless you have a
Oh.
big news event. Like this week we had CPI, of course,
Oh my
which is
God.
kind
Yeah.
of rare, I think, for options expiration week. But when you get an outlier move during options expiration week, it could really extend more and more because the dealers are squeezed and they kind
Right.
of have to buy stuff more on the way higher. But I would say, I try to reduce entering new trades during options expiration week and just kind of focus on how the market reacts to it afterwards. So a lot of
Right.
times you might get a move down in the days following options expiration if
Right.
we're in an uptrend. So then that's a good example of waiting for that to happen and then taking advantage of it by entering some new trades to the
Yep.
bullish side or selling puts after
Right.
that reaction. But really, I think instead of trying to predict a move, I do like to be more contrarian when everybody's on one side. But
Right.
instead of predicting what's going to happen, just wait for that thing to happen uh, and then react to it by maybe
Yeah.
selling premium after a volatility spike or a pullback. You can get into whatever you wanted to get into, but
Definitely. I excuse my language, but gamma is a bitch, and people don't understand how much this thing moves when there's less than 21 days for expiration. When there's 3 or 4 days, this thing is gonna rock. And I love what you said about MGI, what I call market generated information. Why, if the market, is telling you something, don't anticipate it, then just follow what it's doing. And I like that. I like
yeah,
that.
market generated information comes to us every day, right? The
Every
market is
day. We're all
it's like
watching this stuff every day.
yeah,
Definitely.
like I always tell newer people that don't really understand the mechanics of the market. Like this is just a big ongoing auction, right? The
It
auction
is.
process. If
Yep.
you know about market profile and read about how supply and demand works. It's literally just an ongoing auction every day of the year, and the market builds upon that auction, and buyers and sellers dictate where it's going to go next. So instead of trying to predict it so much, like to some extent that's fine. You could kind of have a bias, right, or a opinion or an assumption, but really waiting for that market to show you its information based on volume or volatility specifically. I like to follow the VIX and how it might clue you into divergences. So just tracking that kind of stuff and then
Yep.
understanding the seasonality, the breadth, and the sentiment of the markets. That's going to kind of put you on a path to follow that market generated information and maybe even fade it, right? If you
Right.
think it's over or going to turn soon, then you could, yeah.
I wanted to ask you about your worst trade this year, because people think that all these guys never talk about their losers and their mistakes. And I see, I don't know, I want to get your input. I see traders do two kinds of mistakes. One, because they traded the wrong strategy with the wrong probabilities. And the other t- time when they lose money is when the market didn't cooperate. And, there's nothing wrong with that. If you place a correct trade, mathematically correct trade, correct size, everything you thought about it correctly, and then the market didn't perform the way it should, you know that's why it's trading, it's not winning. So I don't mind having losers when I traded fundamentally correct. But I wanted to ask you about your worst trade this year, and if it was created by the market not cooperating, or did you go on a limb and place the trade that you shouldn't have placed? And I think people would gain a lot of value from that.
Yeah, I mean, I definitely can think of at least a couple,
We all
bad
have
trades.
some.
Like, there's no like one worst trade probably of the year, but I do know, thinking back, I remember back in the springtime, like gold and silver were looking pretty explosive, and I was in a pretty bullish trade. Like, I think I just owned call spreads on GLD and SLV,
Yep.
and they doubled, I think, in a short amount of time. I was kind of like playing for the multi-month type of breakout, and gold started going higher and going higher, and I think I took profits on half my position at like 50%, and then just let the rest ride because I had options that expired in like 3 months,
Yep.
so I had time to wait. And it really looked like gold was going to explode through like 2000, and then it didn't do that. It pulled back and it peaked
Yep.
with I think that coincided with the dollar bottoming at the start of the summertime, and the dollar started a pretty strong move to the upside. So gold, silver, and commodities kind of took a back seat down. But I think I remember adding to my position on the pullback, and I turned a winner into a loser, basically thinking that I was gonna just hold it long term. So sometimes like having that mindset of, oh, I'm going to turn a short term trade into a long term trade,
Right.
that gets me in trouble sometimes.
Oh
So
yeah.
I definitely sometimes like to think of longer term trades in a different account helps you.
Yep.
and then keep your shorter term account in a separate mind state. But
Yeah,
yeah, I think
looks
commodities are tough to trade in general, so
yeah,
I think they do fake you out a lot.
yeah.
But that chart of gold right there, I think, shows you the start of I guess it's like 2022. But yeah, either way, that trade comes to mind.
Oh, sorry. Let me put the year to date. There we go. Sorry about that. Yeah, it's funny that you say gold. For me, gold is not really a commodity. Gold is to me, it's the only one of the commodities that I consider a currency. And the reason I consider a currency is because it trades inverse to interest rates. And it's, when interest rates, gold works when interest rates are going down. Look at the chart recently. We had a reduction from the 10-year yield from 5% all the way down to 455, 460. And look what happened to gold. And so to me, gold is one of those curious commodities that don't perform like they should, But everything else, I agree with you. But look at oil. Oil has had a terrible, terrible time. And the other trade that you had a trouble with was you said the US dollar, or what was the other trade, Jason?
Oh, I was just saying the gold peaked, I think, early this year
Yeah,
when the dollar kind of started to go higher. So
yeah,
I can't
yeah.
remember what month that was. Maybe,
Well,
uh,
here's a chart of the US dollar. Let me give you the last 3 months,
yeah,
the last 6 months.
6 months
And
maybe.
the
So
US
right
dollar
around,
has been
yeah.
just on a ripper. Look at this.
But
It-
now you see this past week it broke below that 50-day moving
yep,
average. It looks like
yep,
so. I think it's peaked for the medium term right now, and that could actually get gold going higher. I don't know. I think oil is kind of stuck in a range between 70 and 80 probably the rest of the year.
right.
So it's probably if you trade oil, you could probably sell strangles on oil because the implied volatility is pretty high on crude oil right now. It's
Yep, yep, yep,
all this news. So the implied volatility in oil options and specific energy sector stocks are pretty good right now for selling puts on those. But
yep.
um,
Let let
yeah,
me let me show let me show the trade screen, and we can take a look at US or CL. I don't know what you like to trade, the CL futures, or you
well,
prefer the USO.
I've definitely traded both, but I think now I like CL better. Understand the futures options a little bit more and how you can kind of get a little bit more leverage in that if you're comfortable with it and understanding uh, the liquidity is pretty good in the oil options. I've
Yep.
noticed
Yeah, it's pretty good. Take a
it's
here.
probably
Here are
I
the
think it's
gold
better
futures.
than USO to be honest. So
Yep, yep. No, I
it's just
agree
a
with you. Look at
bigger
the
product. So
implied volatility is quite juicy. You're right.
yeah, IV rank see that as 60 almost. So
Right, right.
uh, I kind of like the idea of oil staying between 65 and 80 the rest of the year. So I think if you're comfortable with that, it might be a good idea to sell like January strangles or something, or at least even going into your Chevron or Exxon and
Yeah.
selling naked puts on those willing to be assigned.
Would you go to the expected move and maybe sell the
Yeah,
67, the
well, I like to go
67.85,
at least.
or
Yeah, I like to go at least to like the 15 delta if I'm going to sell naked on the futures.
oh,
Uh,
okay,
so
maybe a little bit more. Here we
yeah,
go. Maybe
maybe
more
like
more
60. Yeah,
conservative, right?
yeah, 64, 65, something like that.
Yep,
Uh,
yep.
and then looks like 70% probability there.
Yeah, I'm trying to squeeze this thing.
Oh, you have the 85. I see. I was trying to see what the strike
I have
was.
the 64.5. Let me see. Let's see the 64.85, something like that. Is that a trade that you
Yeah,
might like?
yeah. So you see there, like the buying power is about 6,400, and you could collect 2,400. So
Right.
remember, the multiplier is 1,000 on crude oil. So you're
Yep.
collecting 240, but it's really 2,400. So just think about if you take 50% of that 2,400 as a
Yep.
profit target, that's 1,200 bucks, and divide that by 6,000 or so on your buying power. That's 20% maybe in a
Yep.
month.
It's pretty good.
So
I like
just,
it.
just an idea there for Monday if you're needing a strangle.
No, no, forget it. I'm gonna place this trade definitely on Monday. It should pay. I want this trade to pay for Christmas.
Yeah, yeah,
Santa's coming to town, and I'm always looking.
yeah.
I don't know if you're like me. I'm always looking. This trade is to pay for my vacation. This trade is to pay for Christmas. This trade is to pay for alimony. No, I'm joking. I'm happily married, so I don't.
Yeah,
I got
maybe a new monitor that you have behind you there or something.
the alimony. And let me ask you something else. What if you had to change something this year? What would that be on your trading?
Oh boy, I would say I like having positions on, and
Yes.
sometimes it's better. I'm more discretionary and opportunistic trader, like you said. But uh, during quiet times of the month, I think I need to get better with having fewer positions on, right? Especially if they're directional positions.
Right.
And we know like half the time the market does nothing, and then it might spike or reverse for a big move like the past week or two. So like you
Right.
want to just kind of zero in on those opportunities when they present themselves, and then have bigger size or higher amount of positions. So I think that's kind of my goal for 2024 is to understand when it's okay to be in a higher cash position and waiting for something weird to happen, right? Like kind of refer to that as your opportunity, because when the market is doing normal things, there's not a lot of opportunity. But when it does
Right.
something weird and unexpected, that's when the opportunity comes to people that have cash waiting.
Right. On my 20-year career as a trader, and I always write down on my journal what is the lesson that the market taught me this year. Every year the market teaches you something, and I think it's very important to because we all know what lesson we got this year. And but we have to take that lesson and then apply it to our trading plan because that's how you improve as a trader. You know, for example, at the beginning, I was a stupid trader. Used to short everything naked like crazy, a lot of short calls, etc. And the market, really gave me a lesson. And even during COVID, I had too many short puts on, and I was losing, I would say, hundreds of thousands of dollars, not per day, per minute. And so imagine the size of the position I had on. So and I thought to myself, geez, supposedly I'm a good trader, and this is too much. So size kills. The 2020 lesson for me was size. I knew size killed, but I didn't know how big small was. I think I had 30 naked SPX put, and they turned out it was a lot. And normally you don't think it's a lot, but it's a lot. And the year before that, they taught me that I shouldn't sell naked calls. And then you were too young, maybe, but maybe I would say 6, 7 years back, the bond market was going crazy like it's going this year, and I was shorting bonds. And so every year I tried to learn something. And my market lesson this year is that tragedy didn't come, and that's what I got. We're all expecting a recession. We're all expecting a market crash, and my 2023 lesson was that it didn't come. It didn't come.
Yeah, that's it kind of goes back. Like I studied finance and economics in college, and I'm not a macro expert, but I understand when everybody's positioned to that one outcome, then maybe the market has already priced it in, right? Maybe the
Right.
market kind of priced it. Maybe we already had our recession the past year in small caps, right?
Yeah.
The S&P and the Nasdaq held up so great because those companies rely a lot less on interest rates. Like Apple doesn't care about where the 10-year rate is, right? Because they have a boatload of cash.
Right.
Uh, the higher growth companies that need to borrow money, those are the ones that struggled. Um,
Definitely.
and now you're seeing that turn. Maybe if the Fed is done hiking, then now for the next year, the trade might be to own small caps and maybe not sell short the Nasdaq, but at least not expect it to outperform on the upside. Maybe it just goes sideways, and that would be very positive for the S&P. I don't know, but like I always say, like understanding sentiment and seasonality is so big. And one of the main reasons I was bullish going into this year is
Yeah.
based on the fact that bear markets often bottom during midterm election years, and that was last October, a year ago
Right.
now. So
Right.
just understanding that technicality and seasonality is big. But yeah, every year I know, like I've I've been in the markets now for over a decade, and you have a lot more experience than me. But I every year something surprises me, and I have to, it'd probably be a good idea to have a trading journal too and understand, um, you know, what happened this year. There's going to be something else next year that surprises me too. So I got to be ready to have an open mind to anything and everything. Because even COVID, when 2020 came around, nobody saw that coming.
Nobody
Um,
said no.
and once everybody got bearish in March, then nobody would expect new all time highs by the summer, right? That was just the craziest year I think I've ever seen. But yeah,
It was absolutely craziness. I have a friend in Twitter, the PM Collection is one of my closest friends, and he always tells me the last week of October, the first week of November is the most bullish week of the year. And I always say, yeah, that's BS. Especially this year, I thought we could, we're going down. We always crash from oversold. We never crash from all time highs. So he was telling me, hey, Tony, don't get so excited. And seasonality played a big part on it, and we bounced like a mad dog. So it's great. We have to respect market seasonality. I think it's very, very important.
if it lines up with sentiment too, being
Right.
like very contrarian, like
Like
I think
fear
I
and
was
greed.
telling you
Yeah.
another time, like I like to track the NAAIM exposure index, and that kind of shows you where asset managers are positioned, and it
Yeah.
updates every week on Thursday, so you can actually see where the bulk of positioning is. And I think at the end of October it was right around 24,
Yep.
and that usually goes between about 0 and 100. It
Yep.
very rarely gets below 2025. So that was the lowest it's been in a year. And almost always, when you see it get under 25, the returns are positive going out 1 month to 3 months and
Right.
even 1 year. So it worked out just like that. And also, I would add that November 1st is the start of the fiscal year for a lot of mutual funds. So they have to actually put money to work when November starts. So I think that's one of the biggest reasons why November is one of the strongest calendar months. It doesn't even matter what's going on in the world or with interest rates.
Right.
If you get that's why Octobers tend to see bottoms, because
Right.
mutual funds put a lot of money to work in November and December for whatever reason, and it played out so far that way this year too.
Jason, it's not it's there's not a lot of people that your age that have been successful for 10 years. Great job, and I you have no idea how much I enjoyed talking to you this year. I learned a lot. In fact, I'm gonna start putting some downside butterflies to protect some of my positions. I really appreciate that. And it's very hard to meet someone as eloquent as you, and that has had success trading. And can you tell how people can find you and get a hold of you?
Yeah, I mean, I obviously like to tweet or post. I don't know what you call it now, but on Twitter and X, just on my Three Peaks trading handle there,
Right.
just about what I'm seeing, and like to share a lot of unusual options activity that's notable that we're seeing on the website. And if you want to see like that all day long, you can come to optionshawk.com and
Right.
be in the trading hub, and we share real time options info all day long, and then have like a afternoon recap sent out to members, a morning report, and then a weekend report sent out too if you want to subscribe to the whole thing. So
Right. No, that's great. Definitely. Definitely. And you know what I'd like to say? If you want to grow your pile, follow Uncle Tony and follow Jason at Three Peaks Trading. And remember, you gotta risk it to get the biscuit.